Hello and welcome to this mortgage strategy webinar, Engaging with Adverse Credit, in partnership with Pepper Money. I'm Rebekah Commane, editor of Mortgage Strategy, and I'm joined by Rob Jupp, Group CEO of Brightstar, Nicola Firth, CEO of Knowledge Bank, and Paul Adams, Sales Director at Pepper Money. We will be discussing the impact of the pandemic on the number of adverse credit borrowers and how the market can work together to support these clients. Thank you all for joining me today. It's lovely to see you. Rob, I'm going to get the ball rolling with a question for you. Have you seen an increase in the number of borrowers with adverse credit since the start of the pandemic at Brightstar?
So thank you for having us, and thank you, Pepper Money, for sponsoring today. So actually, I was really relieved when the information came through from this wonderful piece of research, because it actually mirrored our own findings, which is actually in the last 14-15 months, much against the rhetoric, we've actually seen a reduction in the number of adverse clients coming forward. I think that's for a number of reasons. I think let's all be clear that government fiscal stimulus has been a major part of that, and also the fact that the courts for repossession only opened again on the 1st of June, so very recently, which meant that people couldn't lose their houses up to the 1st of June. But I think what this does is it gives everyone a bit of a false sense of security, and what we've certainly not seen play out is the full effect of the last 14-15 months. And once the government fiscal stimulus ends, which it is planning to do very, very shortly, then we would expect to see a tsunami of adverse information coming. We've seen, funny enough, with the CCJs, we've seen a lot less smaller CCJs, where I think, for purely reasons of business reputational risk, providers have not put CCJs on, but we've seen some really, really big ones. So where trade creditors have tried to protect their position, often they've gone to CCJ almost straight away, even if a client is in payment plans. So what we're seeing is much, much bigger ticket county court judgments and probably less smaller ones.
Okay, that's interesting. Thanks, Rob. And Paul, do you have anything to add there?
Yeah, I mean, I agree with Rob. I think the numbers in the survey itself are encouraging, in the fact that it seems like, the numbers of adults with adverse credit is falling. And I'm sure we'll go a bit more into detail on the numbers as we go through this. And I agree with Rob. I think once the safety net of the government schemes have kind of been lifted, let's see what happens there. But the good news is, from people who are in situations that they find themselves and they're looking to buy, there are brokers that are hugely experts in that field, and they know which lenders to go to, and there are a good handful of good lenders out there to support. I think in terms of adverse credit, it depends what you deem as adverse. From the start of the year, we've just had record weeks, record months, and we're far ahead of where we thought we'd be this year. And I'm talking double the number of dips and triple the number of applications than we've seen, early 2020, when pre-pandemic, and certainly 2019. So I think, in amongst that, it's simple things as like failing credit scores, where we know that some of the high street banks have tightened somewhat through the pandemic and perhaps have not returned to normality yet. We see a lot of customers that potentially don't have any adverse credit as such. They're just not scoring enough points to pass through the systems, and that could be no credit or too much credit, also a whole host of reasons. And I can see that continuing to grow as we go forward.
Thanks, Paul. And just on that point, you mentioned that we would talk about the numbers, so we might as well discuss them now. What numbers did you see in the recent survey that Pepper Money carried out?
I think the numbers were that we saw, and they are down as a percentage of the UK population, adults who experienced adverse in the last 3 years, we're around 12%. So if you multiply that up and look as a percentage, that's about 6.29 million people in the UK. And 14% of those people are looking to buy a property in the next 12 months. That's the key statistic, and that's where I think brokers really do come into their own. And some of those borrowers are looking for a home, to somewhere to live or to move to, but a good proportion of them are also looking for investment. So it's not just residential, but it's also buy to let.
Okay. And Nick, have you noticed any trends in adverse credit at Knowledge Bank?
Yeah, we have. It's been quite interesting, actually. We've seen a trend sort of building from the start of the year, where we've seen more adverse credit categories being selected, in particular missed or late payments, and also, interestingly as well, defaults satisfied within the last 3 years. That's moved from being in the top 10 right into the top 5 for the last couple of months. So that's quite an interesting one. Possibilities for that around people perhaps not spending money on going out, that kind of thing, looking at clearing debts. It's one theory. But what's been really, really interesting is what's featured of the last 3 months in the top 5 is soft footprint dips. So brokers are looking for lenders that do soft footprint dips because they're very conscious of their protecting their clients' credit, and they don't want to risk a hard footprint if it's perhaps the lender's going to say no. So that's a really interesting trend that we have seen grow, and it does look like it's there to stay. I have to say, even looking at searches this month, again, it's going to appear in the top 5 so far. Sorry, last month even.
Okay, interesting. Paul, you touched on the fact that there were also adverse credit applicants in the buy-to-let sector. Rob, in the other specialist areas, have you seen any kind of trend with adverse credit in terms of a rise or a fall, or?
Yeah, actually, Rebecca, more so. So particularly with commercial finance, we've recently brought in a corporate finance restructuring team within our London business that I'm speaking to you from here today, because 3 sectors in particular, care homes, hospitality and tourism, have been particularly badly affected by the pandemic. So a lot of the existing top 5 lenders within those sectors are looking for a reason to exit those loans because they're deemed as either too risky from a risk weighting scenario, or they're not particularly priced commercially, feasibly in this current world. They're too cheap. So what we're finding is there's a whole host of those clients that have breached warranties, some majorly on loan to values and care homes, amount of occupants within their care homes for obvious reasons. And these clients are often given 28 days in which to make full and final settlement to pay existing facilities off. So we're particularly busy in those areas. The other thing as well is development finance. It's kind of fallen off the face of a cliff edge where a lot of developments have been half completed. There's been an issue with overseas workers, particularly Eastern European overseas workers, going back home. And post-Brexit, there not being enough people to deal with that. And then, sort of terms are being breached, covenants are being breached, and sites are being put into receivership. So I think, there is a subsection of the economy, the SME, that sort of powers UK PLC, that at the moment is in a spot of bother, and it's really essential for speciality finance and challenger banks and non-challenger PRA FCA funded organisations to try and fill the void of the lenders that have just abandoned vast chunks of UK SMEs.
Okay. Paul, would you say you've seen similar at Pepper?
Yeah, I mean, We're a residential and a buy-to-let lender, so I won't talk about the commercial elements that Rob's gone through. But I think that the study it kind of shows a bit of a divided nation. There's lots of people that have come out and through the pandemic having strengthened their financial position, and significantly so. And there are others that have really struggled. And I suppose when you look at adverse credit in particular and the reasons behind that, particularly over the last 12 months, you're seeing the word furlough mentioned a lot. Actually that was the majority of the reason for people finding themselves in not being able to maintain their debt. Furlough, income reductions, people having to take pay cuts just to stay employed. Lots of self-employed people have experienced a drop in income. And unfortunately, there are a number of people that have lost jobs and are probably looking for jobs now or have recently started a new job. And all those categories, I suppose, whether you've got adverse credit or not, cause a lender not a problem necessarily, but a reason to look further into the case and make sure that the right lending decision gets made. So I think it's not just about adverse credit. It's just I think specialist lenders such as Pepper Money, because we are not reliant on a credit score and we have set our stall out to manually underwrite individual cases on their own individual merits. It just allows us to take a wider view of situations like that and formulate some policies which we can explain to brokers.
Mm-hmm. That makes sense. Obviously, the crux of this issue is how the market can work together to support borrowers with adverse credit. Nick, what do you think is key to helping these borrowers?
So obviously innovation with regards to criteria and looking for ways to lend is imperative, but also I think as well the market can perhaps play a bigger part in financial education. I think unfortunately, a lot of people, by the time they come to get a mortgage, they've perhaps already made the mistakes because they've not had that financial education in place. They've maybe listened to people that said, look, you need some credit, take a payday loan and that will show that you can pay something back, which is terrible advice, as we know. But of course, they're listening to the friends down the pub, listening to family members, and not professionals and experts in that. I think as well, if anybody can sort of grab first-time buyers right at the beginning of their journey and give them a little bit of advice, even if that's something like, look, if you have a credit card, just set it up so the minimum payment comes out every single month. And then if you want to pay more, you can, but you're not going to miss a payment because missed and late payments are the biggest cause of adverse credit. We see that on the searches on Knowledge Bank. But even with the study that Pepper did, it's 4.72 million people in the last 3 years had a missed credit payment. That's 9% of the population. That's huge. And these things can be avoided. So that's quite a huge chunk of the market that we can perhaps help. Obviously, you've got more serious cases where debt is, it's not down to maybe just missing a payment or being careless. There's a more fundamental issue that needs tackling. But I do think financial education can really help. And that's something that as an industry, I know Rob and Brightstar leading the charge with that as well. But I do think it's really, really important, as well as that innovation from lenders, looking at real life problems, looking at credit blips and thinking, actually, is there a way to lend on this?
Great, thanks, Nick. And Rob, the same question to you. How do you think the industry can come together to help these borrowers?
Well, I think Nick has made some really great observations there. I think education's always been really, really important and continues to be very, very important. And I guess the challenge at the moment is advisors being stupidly busy, making sure that we find creative ways for them to be able to engage and get that education whilst doing their day jobs. But I think sort of a really important part here is a bit of a call to arms for lenders. And really not so much lenders, but both the PRA and the FCA to actually agree with what's going to happen. So what I mean, 3 areas. How are you going to treat customers that have missed mortgage payments on the consent and agreement of the lender? Are you going to have a problem with them or not? Because at the moment, some lenders do, some lenders don't. And there's sort of Chinese whispers about how people feel. Secondly, how do lenders feel about individuals that were furloughed? So, if they were furloughed, how long for? Does that mean they're in an occupation that perhaps could be furloughed again? And there's some inconsistencies with lending processes if someone's been furloughed. And the third thing, which is really, really interesting, is a lot of people don't know this, but part of the deal of receiving furlough payments now is that you have to have your company listed as a company that receives furlough payments. So there is a bit of an undertone to say that if you're working with a company that's currently furloughing staff, even if you haven't been furloughed, you're back to work full time, does that mean that there's an underlying sickness in that business, and at some point you might be out of a job, and and therefore you're a higher risk? So at the moment, these three things are huge inconsistencies. That actually, if you're telling people that already don't have the confidence that they can get home ownership, you're also adding to that. If you've had a mortgage and you've missed a payment on the consent of your lender, you won't get a mortgage. If you've been furloughed, you won't get a mortgage. And if you work for a company that currently furloughs people, you also won't get a mortgage. Then you're already making a very bad situation considerably worse.
Mm-hmm.
Can I just pick up on a couple of those points, Rob? And just in terms of payment holidays, you're saying that some lenders will not lend to borrowers who've taken payment holidays and others will. And it's the same with having been furloughed. Is that accurate?
Yes, that's accurate. And I think what you're finding is, I'm afraid, a lack of transparency with lending decisions, whereby a lender will go, no, that doesn't meet score, or that's not one for us. And then it's only when you kind of scratch below the surface that you're able to have a conversation. Well, they're in hospitality. That's not someone we want to lend. It was like, hang on a minute, they work for a major brewer at the head office. They haven't had a day off throughout the pandemic, and they've still had to work. Yeah, but they're in hospitality. That could be a business that goes so bust. So there is. I get it. I get the reasons why lenders might feel like that. I think it's a logical stance. But I think what they're also doing is they're second guessing what the regulators want them to do. And I think sometimes with a rules based compliance environment, they make the wrong decision. So I just say, let's just be clear. If we could just all be much clearer on that, it would be much better for everybody.
So we need consistency in that regard, for sure. And Paul, as a lender, what's your view on that?
Yeah, I mean, I do agree. It's sometimes difficult, I suppose, to give that level of transparency, because often, I mean, you hear the words, well, it depends, and I suppose when how people reacted to the pandemic, if they were furloughed or had a reduction in income, how they conducted themselves at that point in time does say a lot. So when it comes to sort of manually underwriting a case where somebody has been on furlough, bank statements are a key part of that, because did they try and control their spending? Did they carry on as normal? What happened? Because that kind of gives you a bit of inside information into that person and helps you to formulate an opinion. So, but again, I think that's where specialist lenders do come into their own, because we can do that, because I suppose we've laid our stall out to be that type of lender. If you're a high street bank, it's often too difficult because your volume's much too high. It's a conveyor belt, and you need to, get cases through the system.
Yeah, can I add, sorry, Rebecca, can I just add on that point that Paul's just made? And the challenge is, when a client goes to their high street lender that they've been banking with for years and gets a rejection, often that's where the journey stops. They don't then decide to go and speak to an intermediary and find out there's lenders out there that can help them, like Pepper. So that's the challenge. I think it's that first rejection, making sure that doesn't stop the quest for finding a mortgage, and that they do have the quest continuing via an intermediary, which is the only way we'll get that solution.
Definitely. And I think my call to action really for brokers would be to continually search. It's very difficult because there's deadlines in place now. Everyone is so busy. But a customer that gets that initial view that you're going to struggle, that's the view they remember probably for life potentially, and carry on renting, don't buy. And that's a shame when you've got lenders, you've got packages, and Rob's business, when you've got systems that have been generated to support brokers with knowledge of where these cases can go, i.e. Nicola and Knowledge Bank. If you're a part of a network, you've got a placing desk who are expert. We spend a lot of time with these people to make them experts, understanding what we can and can't do. A quick phone call to them, and to us, we can take calls. I mean, we've never been busier. And what I've noticed actually over the last couple of months is the average call length per call coming in with a new inquiry has increased quite significantly, because we're having to talk about more complex scenarios, and it's taken longer to get to a decision that we're happy to make, or whether we're happy to accept that case. That's not a bad thing. I think it's just a sign of the times. But I suppose what I'm saying to brokers is, to persist and try and find these customers a home for a mortgage, because it is there.
In terms of the length of time it takes to turn around an application, Paul, is there anything that you advise brokers to do to speed that up from the get-go?
Well, I mean, that's a really good question. And I would say it's not dissimilar to any other mortgage. There may be a few requests for additional information. So a good one I mentioned earlier is bank statements. We do request bank statements on every application, apart from buy-to-let. And because when you're manually underwriting, they do help to paint a picture and tell a story. But other than that, the information we request is no different. And at Pepper Money, the one thing that we've done this year is we deliberately start every single application with a phone call to the broker from the underwriting specialist. We found that has reduced the processing time significantly, and the conversion ratio is much higher, because it allows you to have that upfront conversation about the background of the case to begin with. But then if we're asking for A, B, and C, but B can't be provided, but they could provide something else instead, it allows us to have the discussion and decide whether that be acceptable or not, rather than going backwards and forwards, uploading documents that we don't need, or etc. And we can cut through all of that with that phone call at the start. So we ring every broker at the point of FMA to go through that with them. And we've literally just installed a new telephony system whereby if a broker's calling us about a specific case that we're processing, they enter the last few digits of the reference number, and it routes them straight through directly into the underwriting specialist that's got that case, so that we're trying as hard as we can just to keep the conversation going with the same person, so there's consistency.
Okay, sounds great. Whilst I have you all in the same room virtually, is there anything you'd like to know of each other about the adverse credit market?
Good question. I suppose my question to Nicola would be, well, and I think you pretty much covered it earlier, is that the highest search criteria that's put into Knowledge Bank when it comes to adverse credit, is it consistently the same stuff, or does it change from time to time?
It can change, but we do consistently see missed and late payments. That does seem to be a real feature. Always in the top 10, but more recently in the top 5. So missed and late payments. So out of all of the adverse credit categories that we have to select, it seems to be missed or late payments. So of course, that's where everything else starts from, isn't it? So when we're talking default CC, they all start with missed or late payments. So
yeah.
So it's interesting to see how many are searching at that stage.
So, guys, I think the message to borrowers and to brokers is that the products are out there. You just have to look for them. We need consistency in the market across all lenders, and the supposed rise in the number of borrowers with adverse credit during the pandemic hasn't been seen yet, but may be seen.
Yeah, agreed.
Definitely.
880,000 people, according to Pepper Money's latest figures, are looking with adverse credit. Of that 6.29 million, 880,000 are looking to enter property ownership in the next 12 months. And the great news is pretty much 100% of those clients will find their way with mortgage intermediaries, independent mortgage intermediaries in the UK. So mortgage intermediaries own this market. If you can start engaging with clients, they'll be really grateful. They will speak to other people in the same situation, and you will be very, very busy post the stamp duty at the end of that, and post, house prices perhaps calming down a little bit. This is a fully functional, sustainable market that will keep a mortgage intermediary busy for many years to come.
Great.
That sounds like a great line to finish on. Thank you all so much for taking the time to join me today. It was a very interesting conversation, and I hope to see you again soon.